Okay, good question. That comes from Justin. So we're looking at how the price moves to the downside, and we're looking for any points of the reversal, right? So move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, oops, reversal, which would equal our point of entry, and that would be our first point of entry. Our second point of entry could be this bar right here. Our next point of entry will be somewhere in this area where we are experiencing a backing up action. And our fourth point of entry is probably going to be somewhere here on the breakout. This was not the most efficient in this case entry, but still with your stop losses it shouldn't get you out, so all 4 points of entry you should just go through. Okay, what else? Is it reasonable to take a trade to upside in early January considering reaction looks like a backing up action? Yes. And if you're thinking that this is a backing up action, let's say, oh, I see, right here. Okay, got it. Okay, yeah, this is a good question, but again, we're coming back into the point of, how do we actually manage the position, meaning how do we actually come into the position, right? So we need to see some kind of reversal of this initial move to the downside. There is no reversal, so there is no entry, and that would save us from entering prematurely and from exposing ourselves, to the remainder of this reaction. Why is not a backing up action between February and March? This one right here, yeah, it's a backing up action. Again, it's just minor, right? And then this is a backing up action, this whole formation, and it's a major. Right. So quite a lot of distinctions already, guys, that I've given you. So you have to take notes and you have to remember those. All right, Ramar, really quickly, let's talk about the distribution. So what is the most obvious thing that you see in this distribution?
In that small area of distribution, the most obvious thing is the price action that almost resembles buying climax, the very first bar.
What are the characteristics of this buying climax that we see?
Widespread, rapid rise of the price to a new high, and when compared to the previous high.
Climactic run.
Mm-hmm. Right. And then it's immediately followed by an automatic reaction,
mm-hmm.
and then that is followed by a secondary test which tests the highs of previously established highs.
Please note there are quite a few secondary tests here. The first one is going to be an attempt to retest the buying climax. That would conclude phase A. Okay, let's finish with the buying climax. What else? Gap up is going to be a part of that, climactic stopping action. Actually, as you look through this intermediate stopping actions, this is a buying climax. It's just intermediate, and look how gap is happening here. Look at the move. Look at the gaps here. Also a buying climax. Also a buying climax on a very, very small scale. But we kind of see that this analog repeats over and over and over again. So yes, a lot of climactic action. And what do you think the volume signature here is?
More likely to be moderately high volume.
Mm-hmm. Okay. Something like this. I wonder why moderately. I'm just really curious.
That's because the extent to which the price has moved when compared to the previous high on the left side around just before June leads me to suspect that the volume might have been only moderately. If it was climactic volume, I would have seen a price go a little bit higher.
Interesting. Okay, guys, for those of you who can, quickly find me the volume signature and maybe send me the picture through the chat or something like this. I'm now really curious. My first thought would be that because the next area is the reaccumulation, the volume signature is going to increase, but probably more locally. That's number one. And we probably would be thinking that that would give us, just an idea that we're going to go into the trading range with the bias that is going to be to the upside. So therefore, not a lot of supply signature should be there. On the second thought, looking at all of these buying climaxes, to the upside, we're seeing that there is a big gap to the upside. So there is some kind of event here that stops this whole movement. So this event should have, an increase in the volume signature for sure. Plus the whole day it just goes up. So that should, have some kind of demand behind it, especially at the higher levels over the resistance. So I wonder what the volume signature is. Okay, we'll come back to this. So buying climax, automatic rally, secondary test, our phase A is defined. What is the next phase that could be easily identified right away?
Phase C, again, the price where the price comes and tests the support level, and followed by
Hold on a second. We are discussing a distribution, right?
Yeah.
So with the distribution, we're going to have this type of the schematic where phase C is going to be not at the low, but at the high.
Yeah.
So where is it?
It's right at the July level.
Yes.
Which,
the price commits temporarily above the point of the level of the resistance. So how would we label this then? Obviously phase C.
Yeah.
And what is this Wyckoff event? The price commits temporarily above and then comes back into the trading range.
Upthrust.
Upthrust.
Yeah.
Because this is distribution after upthrust after distribution. Everything between phase C and A is going to be phase B. In phase B, we're going to say, okay, there is a little bit small upthrust here in phase B. There is multiple secondary tests. And then as the price goes down, and we see that the price has some tail right here, it's very hard to see. How would we identify this action? Obviously in phase D now. So this first, at least attempt to commit to the downside, how would we label it?
That would be labeled as a last point of supply.
Okay, so the rally will be a last point of supply, but the move to the downside from the high of the upthrust to the low of this reaction, this whole move right here, that would be what? Think about phase C low in accumulation and move to the upside. The opposite to that, to the downside.
The downside, yeah.
Sign of weakness?
Yeah, sign of weakness, yeah.
Sign of weakness. So it's a little bit condensed here, but here it is. Sign of weakness, LPSY, and then off we go to the downside. Okay, great. So distribution has a very small cause. So therefore, the downtrend should be also small. And we kind of see that. Okay, well then next we look at the reaccumulation range again. Okay, so what is the most obvious thing that catches your eye, Rama?
The most obvious thing is the price leveling off after the sign of weakness and the last point of supply. It establishes a price from which there's a rally that takes place. Okay,
so we're seeing the low that has been created, and then we're seeing a move to the upside. Now, this rally, is this rally much better than the rallies that we've seen in the down move during the down?
Absolutely. Yes, absolutely.
So what does it mean to us? Is this a change of character?
Yeah, Change of character.
Change of character. At this point of time, a change of character would suggest that from a downtrend, we're going to go into non-trending environment and we're going to look at the trading range.
Trading range.
The trading range here, again, the questions that we're going to address was the trading range, bias, timing, character.
Right.
Okay, so and also change of character is going to be associated always on the way into the trading range with phase A. Okay, so if this is phase A, then what kind of phase A Wyckoff events do we have? The stop in action is going to be labeled as how?
Yeah, it will be labeled as a local selling climax.
Yes, and I like that local definition. Okay, great. Yeah. So selling climax, the first rally.
That would be automatic reaction.
And then the next test that's going to test the selling climax is going to be a secondary test, and that would define phase A for us. Okay, so then what is the next most obvious Wyckoff event that you see here?
A rally that goes above the level of the resistance and doesn't commit itself to the price level above and declines into the trading range.
So kind of like this type of action, right? Like we have this up thrust and then we come back into the trading range. And it happens at the same spot, right? So right after phase A, so acts a little bit as an analog, to what we're seeing here. So we're saying up thrust. At this point of time, looking at this rally, you're looking at the character of this rally. Could we say that maybe this rally acts even as a kind of like a minor sign of strength here?
Yes, I would say so, yeah.
Yeah, look at the character. The price moves so quickly to the upside. It commits on actually multiple closes to the upside, actually maybe just one or two. Spend some time there. And this is what's interesting. Sometimes upthrust, look at this upthrust, goes up, commits really quickly, and then by the end of the session already shows some supply, and then the next day comes back into the trading range. This one is different. This one has 3 days that goes above the resistance, and then look at the time that it spends, maybe like 2 weeks above that that point of resistance. So what does it tell us? It tells us that there is some kind of strength behind the price action.
Strength in the background.
Yeah, and that strength, guys, it's not indicative of the timing. By no means think about that, oh my gosh, the strength in early, let's say phase A or early phase B, we should go into this position. No, this strength just suggests to you that this is a reaccumulation, but it doesn't suggest to you the timing. The phase analysis is going to suggest to you the timing as to when we should go into this position. But this strength suggests that the bias could be to the upside. So now you're just looking for the confirmation of this information. Is it really that the bias is to the upside? Because we're just still too early. We're in early phase B at this point of time. Okay, great. So what's next? If this is, by the way, if this is biased to the upside, we would say that this is an upthrust action rather than an upthrust. Okay, well then, what's the next thing that catches your eye?
Right. The next thing that catches my eye is the disconfirmation. That is, up until this time, the strength of the rally and the commitment of the price to the level above the resistance for a few days tilts my bias to the upside. But on that bias, I always look for to see if that is going to be confirmed by the subsequent price action. In this case, the subsequent price action is indicative of weakness. So it comes down, price declines.
Okay, so we're talking about this.
Right. Okay. And then it comes and produces another secondary test.
Okay. Well, let's kind of grab this idea here from Rama. So he's saying that to come back into the trading range, which we would expect, by the way, in phase B. We've tested, this is a secondary test, it's still in phase A, and this is the first test in phase B. This is the test at the level of the resistance, and we should have a test in phase B at the level of the support as well. Phase B is going to test both resistance and the support. And we've seen how Rama has described that there is some supply or increase of the supply that we see in the spread, in the downward spread. That suggests what? That suggests that if supply is increasing, we need some kind of retest of that supply. And usually, the more supply we have, the more testing we need to be doing. And the more testing we need to be doing, that would suggest that we might go in some kind of trading range. So and we're already in the trading range here. We're just kind of like thinking that it's going to prolong the trading range. Okay, well, if we had one test, which was an supposedly, upthrust action test at the resistance, then the next test is going to be at the support. So how would we label this test in phase B?
I would still label that as a secondary test.
Yeah, secondary test. We are not overcoming the low that was created in phase A, so this is a higher low. So therefore, the higher low in phase B would be labeled as a secondary test at the level of the support. And then a lower low in phase B would be labeled as a secondary test as a minus sign of weakness. Okay, so this is a secondary test, but which one? There are quite a few here. I'm looking at this, I'm looking at this, I'm looking at this, I'm looking at this, I'm looking at this.
I would say the second one, the 1 year mark, where the price reaches the lowest point among that cluster of tests.
Got it. So Rama is saying that this point right here is our secondary test. I would probably have an argument here with you, Rama, because look into this area again. How did we approach it? We approached the whole formation as 3 tests in different phases. And that's what I want you guys to start practicing. I want your eyes and your minds to see this. There are formations that are together, and I'm going to highlight this. Here is a formation where there is an action, and then there is a test. There is another formation where there is an action, and there is multiple tests of this action. And then there is a third formation that is an action and multiple tests after that. So I want you to start thinking in these terms, because we will be defining the texture of the whole trading range as, the construction of, smaller pieces that come together. And locally, when we say locally, then we mean that this test is local to the selling climax, or these multiple tests are local to the climactic action that Rama has identified here, or maybe these tests are local to, the initial selling climax that we have here. Okay, Rama, do you see that?
Yeah.
Okay, so maybe something, to kind of like work with the next homework, just, identifying those areas. Different textures, but different tests, but, they all create the same structure. Okay, so if we're talking about different, textures and structures within the logic structure, then as we've identified tests here and identified the phases there, then I could say that if this is test number 1, test number 1 is going to be associated with phase A. This whole thing is test number 2 associated with phase B. Then this is going to be associated with
C.
Okay, and that's how how simple it is for us to think about this. You know, even though it's such complex structures that we see, you know, in test number 2 and number 3, but they all actions around the same area, right? They are all the tests of the action that we see prior, you know, to testing area. Okay, so if this is the case, then let's relabel this. Phase A, then phase B probably goes to what? To this point right here, right?
Yes. Yeah. Yeah.
And then phase C is gonna either be concluded here or it's gonna be concluded here. So we have two scenarios here. Okay, so how would we, let's say, is there any other labeling that we need to do here? Where is our phase D?
I would consider the second C you have put there as D, more D rather than C,
Okay,
and I would consider the first C to be the real phase C because of the signs of strength I see. It's
right.
making higher lows,
Mm-hmm.
and that to me is the
Mm-hmm.
beginning of the new uptrend.
Great.
And
Okay. Okay, yeah, I like that. At the same time, I would say that there are probably two ways of how we could label this. So let's say phase D labeling at this point. Okay, so two ways. The first one is exactly what Rama is describing. We are in phase C here, in the smaller formation. Then look at how a rally is committing to the upside over the what seems to be an apex formation. And we know that in the apex formation, the sign of strength is actually not going to be very good. You know, it's not going to be extremely distinct. But what it's going to show out of the place of uncertainty, right, where both buyers and sellers are inactive. They're just waiting for new information to arrive, you know, either to act on the bias, or maybe to add to the bias, or maybe to close the bias that they have. So at this point of time, a small sign of strength suggests that there is a little bit more buyers, and their, you know, supply is exhausted at this point. So we could move the price much easier. So a sign of strength in the apex formation is always going to be that small thing, and then the backing up action comes exactly on the second reactionary leg to the downslope in the resistance. So that acts as a backing up action, and therefore this is phase D. So this is what we have: apex, and then a sign of strength that is going to be just a little bit small. And then the second label in here, which is also acceptable, is going to be more about a much larger phase D, right? So we could say that this move to the upside that overcomes the upthrust action and the buying climax of the distribution formation is a major sign of strength, and by definition the price goes through the trading range, commits to the upside, and look at the commitment, so many closes above, so this is a really good commitment to the upside, spends some time in there, and then reacts exactly to the area of the support that acted before as the resistance. So therefore we could see a major sign of strength with the major backing up action, and then we would identify this as a minor sign of strength. So that labeling is also acceptable. Please note that for trading purposes, again, it doesn't really matter. Why? Well, because if you're identifying this as your potential phase D, then your position in reaccumulation is going to be most likely the first position is going to be opened in phase C. Your second position is going to be, and third, your second, third, and fourth position are all going to be here. So from 1 to 4, all of this is going to be a very active zone for you to act on. And then after the major sign of strength and the major backing up action, that's number 5 that you would be thinking of opening. So from that perspective, doesn't really matter. you will still be operating in this space. You still will be a buyer here. All right, Rama, really good start. I definitely feel a lot of kind of like knowledge that is already there. So a lot of, I also hear a lot of correct semantics that are associated with this course, so, so a lot of things. So just continue. And for you specifically, I would say nuances, details are going to be extremely important, right?
Okay.
So just, absorb all of this knowledge and just make notes and, concentrate on those details.
Yeah.
All right, great. Thank you.
Thank you.
I'm sorry, Ram, I muted you. Okay. All right. Let's quickly look at that question that we had. And thank you, Lee, for sending this chart. That was really quick and cool. And sometimes I'm going to request you guys. I don't want to be distracted, but you guys could definitely quickly find what I'm looking for and email me. So we were looking at this spread, and we said that most likely the volume signature is going to increase here. Why? Well, look at the gap. That's number one. So that usually is some kind of event, probably, well, definitely overnight event, where institutions have not produced so much excitement before. Like any other gaps that we see on the way up, they are much smaller, right? And this is not a gap. And then this is a huge gap. And the huge gap is always going to be associated with more interest from institutions, and we see a continuation to the upside. And actually, I forgot to mention that, this change of character bar most likely is going to have also a very high volume signature just because of the function of the supply that came on the buying climax itself. So that was a really good call. And then also, this is going to be one of these exercises that I'm going to give you guys in the practical when you're going to graduate to more advanced level. One of the things that we practice in the practicum course is reading the volume signature of the price and reading price signature of the volume. What it does, it kind of opens up the new dimension of understanding as to what do we expect the volume on the price to be on the specific bar, whether it's the price or the volume bar. And that's exactly what I did here, just kind of like deducing as to what kind of volume signature could be at this contextual place with this particular bar. All right, great. Let's look at some questions really quick. What is the difference between labeling secondary test after the selling climax or labeling a shakeout, reaccumulation versus shakeout schematic? Okay, yeah. So this was the question here. Selling climax, automatic rally. Could we possibly label this as a shakeout? Yeah, we can. Usually the shakeout in the reaccumulation is something where we have the buying climax and then we have some kind of shakeout right away. We don't have it here. We have a buying climax and then we have an area of the distribution. And that usually suggests, the distribution usually suggests what? That there's going to be some kind of downtrend that's going to come. And downtrend is going to be concluded with the stop in action, which is going to be labeled by us as a selling climax. So my preference in this particular case would be just to label this as a selling climax and extend the boundaries, from the selling climax and from the automatic reaction or automatic rally, rather. And then in the reaccumulation structures where we have a very quick move to the downside without a lot of the distributional activity, you could say like, okay, this could be interpreted as a shakeout action. I will keep this in mind and I will point this maybe on other slides. Okay, next one. If we were in September And I'm assuming what, September, where? This September, or, and this question comes from Philip, or this September. Okay, so probably this one right here. So if we were in September, wouldn't we interpret the rally as a phase D with backing up action right before September? This one right here? Okay, and the backing up action to what? To which range? To this one? So backing up action should be coming back to the formation, right? To the original formation. So we have, for instance, we could say that here we have a minor backing up action, and it's a part of this formation. Then we have a larger backing up action, major backing up action, and it's a part still of this whole formation. Uh, you know, if we would have some kind of, formation that would be something like this, where we're seeing that maybe this whole move is a sign of strength, and then this is a backing up action that has its own trading range, then probably yes, we could do this. I think it's less obvious in this case, Philip, so I probably would be just thinking that it's just a trading range on its own. It's a reaccumulation. We had an accumulation range, a move up, and now we are just in the reaccumulation. Okay, but good clarifying question there. Is it common that one can identify phases of the larger range with smaller local ranges within that larger range? Yeah, we could definitely do this. One of the things, again, to do is that, texture analysis, right? So if you could instantly see that there are smaller ranges here that could be labeled, by the way. I mean, look at this. Sell and climax, automatic rally, secondary test, phase A, B, B, C, sign of strength, backing up action or LPS, major sign of strength, major backing up action. Sell and climax, automatic rally, secondary test, phase A, B, B, C, sign of strength, shakeout type of action in D, LPS. Here we go. This one, selling climax, automatic rally, secondary test, phase A, B, C, LPS, and so on and so forth. So you could see how you could label even smaller structures. And again, we could label this structure right here. We could label this structure right here, this structure right here, this structure right here. Everywhere there are trading ranges. If you just get this concept that you look at the markets through the prism of different structures, whether it's a trend or non-trend, whether it's at the higher, larger time frame, like a large formation, or a smaller formation, like this 3 that I've shown you. By the way, here is another range. Here is another range, right? So all of those are just ranges between the swings of the trading range. If you can understand this concept and it kind of becomes natural to you, you will start looking at the market in a different way. And usually during the first months, I receive a lot of emails from students that just say like, oh my gosh, I look at the markets, I look at the chart, and all I see is just all of those formations. And it's so much easier for me now to interpret the market action, through those formations. So hopefully we'll get to this point. All right. Okay, what else? Okay, so a comment from Doug. Actually, preliminary supply in May, and then buying climax in July. So, what are we looking at? This preliminary supply, Doug. Is this the one? Is this the formation that we look at? And buying climax in July, like this? Was that your interpretation, Doug? to the right for, this is the preliminary supply, this. Okay, great. Okay, so so Doug is suggesting, what about this type of labeling, right? So buy-in climax, then obviously we could go with either sell-in climax, or we could go this whole thing with the automatic reaction and then secondary test. This could be phase A, and then let's say phase B, and then phase C. On the level of trading, because we will be trading here, that doesn't really matter. And if you label it like that, that's fine. Where I have the problem with this labeling is these 2 points right here. So I'm going to redo this a little bit, and then you'll see what I mean. So let's say that we're still in the automatic reaction secondary test, phase A, and then it goes into phase B and phase C. This doesn't really matter to us. But what comes before? When we put, let's say, a buy-in climax right here as this point, we're basically neglecting the fact that the buy-in climax characteristics happened before that. And we went through those. A gap, acceleration to the upside, climactic run, acceleration of momentum, extreme volume signature, which just basically screams at you and tells you that if it stops on this climactic volume, then most likely this is a buy-in climax. So it's the character that does not allow us to say that this is a buy-in climax. So therefore, the second point here is that it has its own formation. So what is the bias of this formation? The bias of this formation is the distribution, so therefore we would be labeling this as an upthrust in phase C. So therefore the preliminary supply is going to come somewhere here. So that's the only thing that I would redo. But everything else, again, for trading purposes, you could say that this whole thing is the buy-in climax. So sometimes I would say buy-in climax trading range. What does it mean? This means some kind of distribution, local formation that would take us down. But you know, I would probably not identify this necessarily as a buy-in climax. So this whole thing, you could say a buy-in climax trading range. All right, great. Thank you, Doug. And what else? I thought that in phase D, I should search for biggest rally of the whole range starting from the support level. So the part of the first phase C should be in phase D, so from Phillips. So we're talking about this spot. Okay, so yes, when we look at the horizontal range, we're looking at the sign of strength and the backing up action as our change of character confirmation. And usually the sign of strength rally will be the largest rally in this whole trading range. And that's in the horizontal formation like this, right? In the apex formation, where there is a lot of inactivity by market participants, as small a sign of strength could be that timing mechanism that defines a change of character. So we would be looking at the at all of the rallies that occur after the last point where supply has increased or supply has produced some kind of downward result that was exceeding the result to the downside before. And we see that the rally there, this rally, is basically the best rally that we see in this formation. So it's a little bit of a nuance. We'll talk about this later on, but I'm so happy that you guys are seeing this, that you're asking the correct questions. Because if you're asking the correct question, this means that the logic that we explained before was also good, and we just did not cover this. So that's great. All right, so really good exercise. All right. Okay, so with each of these slides for the homework, I'm going to give you guys my interpretation, and you could go through this as a homework and just observe all of the labeling that I've done here in these boxes, gray boxes. I'm identifying changes of character, and so on and so forth. So hopefully that's helpful. Now let's talk about phase boundaries. So this is that theoretical slide that we're going to have, and we're talking about accumulation here. So how do we define phase boundaries? It's extremely important for us to understand where we put the boundary. And sometimes it becomes so subjective that as I was receiving so many questions from students, I realized that I need to kind of like, stop all of this discretionary talk as to where we are putting the boundaries, and that just to define exactly where we would put that border between phases. So let's go through this. And we're going to start with something slightly different. The first thing, and this is one of the most important things right now at this point of the course that I want you to remember, I want you to remember by heart the sequence of Wyckoff events throughout all of the phases in accumulation and the distribution. And therefore, I just want you to remember that phase A is going to start with the preliminary support, go into the stop in action by the selling climax, change of character as an automatic rally, and confirmation of that change of character as a secondary test. That secondary test is going to be a local test, and test number 1 to the sale and climax. Phase B is going to have in the accumulation either a secondary test at the support level or an upthrust action at the resistance level. So these two are mechanisms of testing. Testing what? Testing both supply and demand at the support and the resistance level. In the instances when the price is going to overcome the resistance, we're going to say that we're looking at the upthrust action. Sometimes I label it as upthrust action, like this, UTA. And then if we're going to have a lower low, then we're going to label it as a secondary test, as a sign of weakness, as a minor sign of weakness, actually. Yeah, some smaller corrections here are needed. Phase C is going to have either a high low, and we're going to label it as a last point of support, or it's going to have a lower low, and then we will be talking about either a spring or a shakeout. Phase C also could have a test, not necessarily a secondary test, but a local test to a spring or a shakeout. Phase D is going to have last point of support, sign of strength bar, sign of strength rally, and a backing up action. Usually phase D will be discussed mostly around sign of strength rally and the backing up action. A sign of strength bar has been added, to the methodology by me, just for the class purposes. This is the spot where in the middle of the range we're identifying emergence of institutional urgency to buy, to be in this position. And this is one of the points of entry for us in accumulation on the way up. We'll talk about this more. Last point of supports are going to be all of the reactionary lows on the sign of strength rally that present some kind of buying opportunity. Those are going to be short-term weakness situations where we're going to say that the long-term bias is to the upside, but the short-term bias has some kind of weakness, bearish bias behind it, and those are going to be the spots that are going to be associated with establishing or adding to the position. Then we've talked about two changes of character in the reaccumulation. And, originally, again, I've talked about this. Originally, when I was studying Wyckoff method and, Hank was introducing me to this concept, Hank had a concept of the change of behavior. He never actually specifically talked about the change of character. So change of behavior was basically identified in late phase B and in phase C and in phase D. And what Hank was talking about is a change in behavior as behavior on the rally could become more bullish and then behavior on the reactions at some point could become more bullish as well. So for instance, when we look at this chart and we look, let's say, maybe at this reaction right here. For the first time, reaction creates a high and low. So that's a change of behavior. It's not necessarily a change of structure, because a change of character is a change of structure. But a change of behavior is not necessarily a change of structure per se, where we are confirming the best rally, the sequence between the best rally and the best reaction, right? So here's that sequence: the best rally and then the best reaction. So here it is throughout this whole range. So that is a change of character. But change of behavior could be just a better rally and then the reaction is still bearish, or usual rally and then a better reaction. So that would be a change of behavior. There are two changes of character that I mentioned. Our first change of character is going to be associated with phase A. So it's the change of character into the trading range, and it's going to be defined as the rally between a selling climax and automatic rally, and it's going to be confirmed by the secondary test. And then the second change of character is going to be on the way out of the trading range in phase D, and that's going to be a rally between phase C low and sign of strength rally high. So here's the high, here's the low, here's that change of character, and it's being confirmed by the backing up action after that. Phase boundaries. So this is very important. This is something that I was looking at in all of your homeworks today. So let's go through this. How do we define the boundaries? So let's talk about the boundary between phase A and phase B. Well, what do we see? What do we have to see there? So we want to identify a secondary test as the conclusion of phase A. And then it's around this area, this is where we would be looking for the reversal. Once we identify this reversal, this is where we're going to put the boundary between phase A and phase B. So why would we do it like this? Well, obviously we want to include all of the points of phase A, which is preliminary supply, selling climax, automatic rally, secondary test. And then we want to identify the ending of secondary test. And secondary test is just a reaction. So we want to find the reversal of a downswing that acts as a secondary test. And once we find this bar, that's where we're going to put the boundary between phases A and B. We're going to do the same with the boundary between phase C and phase D. And in this case, it's a little bit easier because we do have another test. And that test is also just a downswing. So for this downswing, we're going to look for the reversal. And the reversal bar is going to be our boundary between phases C and D. So it's somewhere here. And then the boundary between phases B and C is and by the way, let's just do phase D as well right away. So kind of the same concept, right? So backing up action is going to be a reaction. So in the reaction, we want to look for the reversal. So here it's a little bit more complex, like it was here as well. So we see the stopping action, and then we see a minor test. So it's out of this minor test that the boundary would occur. We see here a reaction and the test to this reaction. So it's out of the, that test on the reversal of that test. This is where the boundary is going to be created. Now the boundary between phase B and phase C is a little bit more complicated, because basically we need to understand the intention behind phase C, which is what? Which is testing. This is the final test at the support level. So therefore, from this definition, as this is the test, we need to find the place in phase C, where there is first attempt to test the support level. And we usually look into phase B lows, and we are saying, okay, where is the first time when the lows of phase B were tested? So somewhere here in this area. So, and we want to put the boundary exactly on this level where the test has happened for phase B. So this is how we define the boundaries for all of the phases. I really, guys, would like you to stop here, stop the recording, make some notes, think about this, maybe take a chart just to go through that, and just to think about how you put in those boundaries. All right, great. Let's go to the next slide. So we are at 10 to 5, so we have still maybe hour and 10 minutes. All right, so say yes if you would like to volunteer. Who's next? All right, just gonna go with the first one. Philip, you have to unmute yourself. Philip? How you doing?
Oh, hello. Do you hear me?
Yes. Just speak up a little bit.
Okay, sorry.
Yeah, closer to the microphone. Okay, great. All right, am I pronouncing your name correctly, Philip?
Yeah, thank you.
Okay. So let's look at the first trading range. What is catching your eye?
Well, probably the selling climax,
Which is where?
the large swings.
So let me just label this for you. Point number 1, point number 2, 3, and 4. Okay, which one is the selling climax?
Number 2. The first would be the preliminary support, I think.
Okay, so let's start with this preliminary support, selling climax. So let's go through the logic of this labeling. So we know that selling climax has to be the stop in action, right? And then after the stop in action, what should happen next?
Automatic rally.
Next is going to be automatic rally. And automatic rally is going to be associated with what else? With what kind of change of behavior, change of character? I'm kind of giving it out to you, right? So a change of character,
change
right?
of character. Yeah.
Change of character. So a change of character is going to look like what? Why is it called a change of character? What would we see on this rally that is going to be so different than what we've seen before?
Well, maybe a bigger price swing than in the rally before, and maybe a little bit bigger volume.
Okay, great. And specifically, maybe in this case, because this is an accumulation after the downtrend, demand signature is going to go up, right? So the distance of the rally could increase, the volume would go up, the demand is going to increase, the up spread is going to increase, right? So where for the first time do we see this type of price action and volume action as well?
Well, maybe between 1 and 2.
Yeah, this first rally, right? From this low to this high.
Yeah.
That looks like that rally that you've just described as a change of character. Why is that? Well, the distance for the rally has increased, right? Looking at the previous attempts to rally, where is it? Well, here's one, here's another one, and this is the high, of that downswing. So this is the largest reaction to the upside. Look at the spread; it's increasing as well. What can we say about the volume signature, by the way, Philip? Just looking at the spread itself, what do you think the volume is doing here?
Oh, well, increasing, hopefully.
Okay, and why do you think it's increasing?
Well, because it looked like there was a fight between where the ending price will be and before, like the difference between the range of the tick and of the wicks and the ending prices, I think.
Yes, absolutely. We see, and what is this fight? How would we call this fight? It's the fight of volatility, right? So there is a climactic run to the downside that increases the supply tremendously. I mean, we're seeing how it's a general capitulation here. It's not institutional, it's not public capitulation. Everyone is capitulating here. There is a gap to the downside, big spread to the downside. The first initial momentum is to the downside. So this day on the intraday level is going to look like this. Previous close, maybe open, I'm sorry, open is going to be at the low here. So this is open. And then momentum is going to carry us down first. That's going to be my first initial assumption. Then we're going to have the rally, and then it's going to carry us to the close of the previous day. So that's how the action would look like. So supply has increased, then demand has increased, and then supply has increased again. So there is a lot of volatility during this intraday action, which brings basically the volume signature increase and then most likely some kind of spike on that day. So therefore, a fight between the buyers and sellers creates volatility, which volatility and volume is just, so connected together. And increase in the volume is just, suggests that there is an increase in potential increase in volatility. Okay, great. So if this is a change of character, then where is our selling climax and automatic rally?
Okay, well, so the selling climax should be the lowest point of this.
Okay.
Yeah.
Automatic rally, and then the next move to the downside is going to be what?
Secondary test.
Secondary test. Could the secondary test be a low?
Yes, it could be.
Yes, it could be. It could be a high low, it could be at the same level, it could be a low. The key is, if this is a low, does the price come back into the trading range or not? Because if it doesn't, then it's not a stopping action, it's just a continuation of the downtrend. We could have a low for the secondary test. Yeah. Okay, great. So this concludes phase A. What's the intention behind phase A?
The change of character?
Yes, the change of character, and to stop the downtrend from going further down, right? So stop in the trend and then change the character with which the price unfolds. Okay, phase A. And then what catches your eye next?
Well, the two wicks which are at the bottom of the range. Yeah, the 2 and the 3.
Okay, so kind of like quite a few tests here, right? So smaller test, bigger test, bigger test. So if we would be talking about tests, the magnitude of tests, probably we would say secondary test number 1, that was a local test, to selling climax. Test to selling climax. And then these two tests look like the same magnitude, but they are diminishing in size, which basically tells us that 2 and 3 in the downward distance that is diminishing is a bullish sign. And then look how high they are relative to the selling climax and relative to anything in phase A. So that's an almost like extra bullish sign that we have. So that's all about bias. Okay, so that's great. But then how would we label those, two tests?
Yeah, well, I would have trouble distinguishing which will be the tests in C, but I think it should be the...
Go ahead.
It should be the last one.
And why?
Because,
what's the logic? I mean, this is the correct answer, but what's the logic behind it?
Well, if in any trading range there should be like 3 major tests, so and we have no test after the 3, so the last one has to be the test in C.
Yeah, and this is again, third test is going to be our phase C. Second test is going to be phase B. So if this is third test, this is from where the trend should start. And even though there is
Yeah.
already a definition of the higher highs, higher lows, this is the conventional TA definition of the uptrend. You could argue with me that we're already in the uptrend here. Yes, we are, but we're still in the consolidating formation. It's just upsloping. Then if this is a consolidation and it's just upsloping formation, then we need to identify phase C. So Philippe is talking about the test. So this is great. Looks like phase C. How else could we check that this and confirm that this is phase C? Well, what happens next? Where is the actual uptrend that doesn't have the same type of the reactions that in the trading range? It's in this area right